Hello folks, Steve Lynch here with Discover Options here at Option View Systems. Welcome to this presentation of three different market timing reports for the S&P 500 designed for advanced options traders. This is for Friday, August 3rd, getting ready for Monday, the open on August 6th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All three market timing reports look at the current market condition. Here is how we define it in three different dimensions: price action, trend, and stochastics. In terms of price action, we had an outside bar on Thursday followed by an upswing bar on Friday. That occurred while we are above the 50-day simple moving average in an uptrend. In terms of the stochastic situation, we are between 45 and 85, and we are trending upward with a 15.3 stochastic is above its 3-day percent D. All that makes for a three-dimensional market condition that has occurred roughly 39 times since January of 2000. And that's because of that rare outside bar, okay? You just don't see a whole lot of outside bars in precisely those conditions. And so with that in mind, let's go to the first market timing report for those that like to trade condors and butterflies in a non-directional sense. So since Jan of 2000, we've had roughly 4,679 closes of the SPX, and of those, 65% have been favorable bars for doing condors and butters, because the subsequent 21 bar movement was less than what was being implied by the option prices through the SIBO's skew adjusted VIX. Okay, so one more time, almost 2/3 of the bars in the S&P 500 since Jan of 2000 have been favorable bars for doing condors and butters, because the subsequent 21 bar movement from that bar in the future, the subsequent 21 bar movement was less volatile than what was being implied by the option prices, the skew adjusted VIX. Okay, now also during that time, our current condition, as I said, has occurred 39 times. Of those 39, only 59% of the bars have been similarly favorable. That's less than the 65% benchmark. So this implies a premium selling edge that's negative 6%. So statistically, it's more likely than usual that our current market condition will end up being an unfavorable one for market neutral option premium selling. Does it mean that it will be unfavorable? No. You still have a 59% chance, but that's not even the benchmark historical level. So that's why we say we have technically a negative edge right now. Let's go to the put selling report. This is for those that like to sell puts in the S&Ps, either naked puts, a standard deviation out 30 days away, 30 days out, standard deviation away. Or you could do this through bull put spreads, even hedged bull put spreads. Regardless, we're assuming that the short strike is a standard deviation away, 30 days out. And if the market hits that short strike, a standard deviation away, you would get out for a loss. Okay? So, as I mentioned, we've had 4,679 daily closes of the SPX, and of those, 83% of the time, the market was favorable because the market did not move down and hit that level. All right, the 21 bar downside movement, the actual one, was less than what was being implied by the SIBO's skew adjusted VIX to the downside. Okay, so remember that, 83%. Also during that time, as I mentioned, we've had 39 occurrences of our current market condition. Of those, okay, let me see. What was that? I'm just looking at the number. Is that right? 74.3% of those bars were favorable. Now that's less than the benchmark of 83, and so we have a negative edge of 8.7%. 8.7%. So statistically, it's more likely than usual that this market condition will end up being an unfavorable one for selling out of the money put premium in that fashion. Does it mean you would lose money? Well, no. It still says, technically, if the history plays out, you would make money 74.3% of the time if you did it over and over again under these conditions. It's just that is less than the random benchmark of 83. Okay. Finally, let's go to the likelihood report. This measures, we're looking at basically trying to find a directional bias given our current market condition. So what we do is we look at the random, okay, rate of change. Going back, here we have 4,683 bars in the S&P since Jan of 2000. Okay, the average 5-day rate of change, because the market's been in an uptrend since then in general with some bearish seasons, but roughly 0.1% increase every 5 days, every 5 bars. Every 2 weeks or 10 bars, the market's gone up on average 0.2% or 1/5%. And then the 3-week rate of change on average is at 0.29%. Okay, now we take our 39 occurrences of our current market condition and we run the same analysis. Of those 39, the average 5-day rate of change was pretty much the same as the benchmark of 0.1 to 0.11. Very, very much the same. Okay, the 2-week rate of change is at 0.33, just a little bit better than the 0.2 to the upside. And then the 3-week rate of change is at 0.32, little bit better than 0.29. Not much. The z-scores, at 1% of a standard deviation, 12% of a standard deviation, and 2% of a standard deviation. Pretty much flatline. Okay, now we carve the 39 up in terms of the 26 that exceeded, in this case, Friday's high, and the 14 times that it exceeded Friday's low in this case. And in those instances where it exceeded the high, we now have increases of 0.85, 0.86, and 0.60. In terms of the z-score, turns out to be 0.92, pretty much almost a full standard deviation, 92% of a full standard deviation of the upside, 58% of a standard deviation of the upside, and 22% of a standard deviation of the upside, clearly favoring the shorter term move if it exceeds Friday's high. If it exceeds Friday's low, similarly, we have big moves to the downside, 0.8, 0.61, 0.46 to the downside, z-scores of over a standard deviation on the 5-day level, 71% of a standard deviation of the downside, and then 54% of a standard deviation of the downside. So the motto of the story is watch Monday's price action. Watch Monday's price action, and that should be quite telling. In terms of volatility, on average, the market experiences a realized volatility between 15 and 16%. Our current market condition generates on average a realized volatility level of roughly 13%. Okay, you could break it up in terms of the market action on Monday, and it could be roughly between 10 and 11%. And then if it goes to the downside, look out, because now we're around 16, 17%. Big difference if the market goes below Friday's low as opposed to above Friday's high. So again, motto of the day, watch Monday's price action. The VIX currently is at 11.64, a level quite a bit below what you see up here in terms of the just random 13%. And then to the downside, it is a little bit higher if the market exceeds the high on Friday. Okay? I hope this information has been helpful for you. Sorry for the hoarse voice. We'll see you next week. Take care. Bye-bye.